All right, and we are back. This is our fourth video for Chapter 9 Accelerators in the book Liberate, Your Journey to Lasting Financial Independence. We're going to pick it up here with why higher risk, higher reward investing. So only after establishing the first accelerator, a profitable business, should you attempt the second accelerator. Remember, the first accelerator is needed to begin the second accelerator because you use the money generated from your profitable business income engine to invest in higher risk, higher reward investment strategies with the hope of obtaining higher than average market returns. You are attempting to reach FI sooner by using monies that, if lost, will not jeopardize you reaching your FI in the future. The type of investing I'm proposing is higher risk and higher return, but not unrealistic. Suppose average long-term compound stock market returns are between 8 and 12%. In that case, you might expect between 12 to 15% long-term compound returns with higher risk, higher return investing. You may say, that seems better than average returns, but what about 100% and 1,000% returns? While few individual stocks may experience those returns temporarily, it is like finding a needle in a haystack. Those opportunities are few and far between, and those returns don't last, meaning no stock has a continuous compound return of 100%. As the German proverb says, it explains no tree grows to the sky. No tree grows to the sky. So stocks don't continually go up, 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 and up forever. Earlier, I demonstrated how 4 percentage points can make a significant difference between a 4% and 8% return on investment. Now, let's explore the difference between an 8% and a 12% return. In a previous example, we calculated an investment income engine of $3,753,480. To arrive at this sum over the next 30 years, at a long-term return of 8%, you would need to contribute $33,134 per year. If you can make a long-term return of 12% for 30 years, you would only need to contribute $15,553 per year, or 53% less money. Okay, so let's go ahead and check that out right here. We have annual contribution to reach that, $3.7 million in 30 years. Annual contributions over here, and we can see that at 8%, this is showing us we need about $33,000 per year, versus if we were able to get 12% compound return, we would need about half at $15,553. Excuse me. Okay, so now let's assume that instead of decreasing the amount you invest per year, you contribute the entire $33,134 to determine how much larger the account value will be. After adjusting the 8% to 12% over 30 years, contributing that $33,134, the account value will be $7,996 and change, or 113% more than the original value of roughly $3.7 million. So that's illustrated right here. We can see future account value in millions, and this is, we're putting in that 33,000 over 30 years. The difference here is that we're getting 8%, we're achieving that 3.7 million, versus if we achieve 12%, we're coming out with close to $8 million. Okay, finally, let's imagine you're aiming for the original $3.7 million at 12%, but this time you want to see how many years you can shave off from 30 to speed up the time to arrive at FI. In this case, the years would decrease by 6.5 years, or from 30 to 23.5 years, which is 21.7% less time to arrive at FI. So as you would expect, increasing your investment return from 8% to 12% makes a significant difference. And once again, we just show that here. Here we have, on the x-axis, we have the years needed to achieve 3.7 million with $33,000. If we're getting 8%, that's going to take us that 30 years we originally calculated. If we can get 12%, we're going to shave off some time, and it's only going to take us 23.5 5 years. So I've already talked about how no skill is needed to obtain average market returns. In addition, beating average market returns is challenging because the competition is fierce. Money managers are scouring the same investment universe you are to extract returns and seek even the smallest advantages. These money managers have more time, more money, and more expertise than you do. It's not impossible to discover untapped opportunities, but once found, they eventually become exploited and lose their edge. Markets ebb and flow, and money pours into one sector and out to another. It is a challenging game to win consistently. It is not impossible, but difficult. Market index funds contain average returns because they represent the entire market of both leading and lagging returns. Thus, to logically increase your average returns, you must decrease the number of stocks in your portfolio. You must have a more concentrated portfolio of stocks. Specifically, that portfolio of stocks, regardless of your orientation toward value or growth, must contain more stocks poised to increase in price than decrease if you want to have any chance of beating market averages. However, this strategy increases the portfolio's risk and requires a strong ability to identify stocks that are likely to outperform. In addition to a portfolio of concentrated stocks poised to rise, you must rely on a process that removes emotion from your decision making. That process should have a clear system for gauging value. This concept is paramount because, as pioneer growth investor Philip Fisher notes, the stock market is filled with individuals who know the price of everything but the value of nothing. Therefore, you need a method to gauge the value of individual investments accurately. Also, keep in mind that you can't expect to outperform the market in the long run if you are doing the same things everyone else is doing. Your strategy should also use well-defined criteria for buying and selling investments based on data and analysis, not gut feelings. The process should include testing the investment strategies against historical data before implementation to ensure validity. After validation, the strategy should be executed consistently, regardless of market fluctuations. Finally, in order to have a chance at obtaining above average market returns, it is important to automate as much of the investment process as possible by establishing programmable rules and loss limits. Strive for long-term consistency over one-time windfalls to maintain confidence that your investment process is replicable. And keep historical long-term market behavior in perspective instead of short-term market noise. Additionally, consider using multiple non-correlated investment strategies simultaneously. Okay, so before we're going to go ahead and pause in just a minute, but I'm going to go through an extra lesson in risk management before we end this video. So I believe in taking calculated risks. A calculated risk usually has a higher chance of winning than losing and or a much larger potential gain than loss. One of my favorite quotes about this concept is by legendary U.S. hedge fund manager Larry Hite, who said, "There are actually 4 kinds of bets: good bets, bad bets, winning bets, and losing bets." When you make a bet, you don't know which one will be the winning bet. All you can control is placing good bets instead of bad ones. So you must focus on recognizing good opportunities. Again, that means making an educated decision regarding the risks you take. You want the risk of winning to have a greater chance of occurring than the risk of losing. You also want the amount you could earn on the winning outcome to be multiple times larger than the amount you could lose. Whether the risk is a good risk to take or not can be based on descriptive information, numerical data, or both. It doesn't matter as long as you determine through correct quantitative and or qualitative analysis that you have a substantial advantage when taking on the risk. Another consideration is that you don't want to risk all your available resources on one calculated bet. Remember, there is still a risk. Even if the odds are in your favor, you could still lose. While you can recover from losing everything, I don't recommend it. Therefore, it is wise to search for opportunities backed by assets that retain most of their value or risk or risk only a small fraction of your capital on any one bet. By focusing on assets that maintain their value, you should be able to liquidate at a reasonable loss without jeopardizing your entire FI if the investment goes against you. For example, buying a residential rental property below market value has a good chance of being sold at minimal losses if you need to exit the investment. Likewise, suppose you only have a small fraction of your entire capital tied up in any one investment and it goes to zero. In that case, you can walk away with minimal damage. For instance, you pay the owner a small fee for the right, but not the obligation to purchase what appears to be a promising business within the next 60 days. However, after doing additional research, you find a compelling reason to walk away. Maybe the numbers didn't add up, or you found suspicious activity. While the fee you paid is non-refundable, it serves as a small price to pay to avoid what could have turned out to be a disastrous investment. Another example could be money spent on licensing an idea that didn't go anywhere. The entire amount spent on licensing is gone. However, it was only a fraction of your capital, and you can move on to the next opportunity with minimal losses. It's all about keeping your losses small and letting your winners run so you can play another day. If you lose all your chips, you're out of the game. All right, we're going to go ahead and stop there and pick up with section 5 of chapter 9 in the next video. Thanks for being here with me today. We'll see you real soon.